1988 to present. I've shown this a number of times. It's important to recognize, and actually the top is chopped off here by the numbers. It actually peaked, rounding it off to say 39,000. That was the peak on the last trading day of 1989. And it's important to recognize that at that point, that was the biggest stock market in the world, bigger than the New York Stock Exchange. The Japanese economy at that time was really dominant in terms of the automotive industry. Michigan was looked upon as an inferior product. The Japanese economy was producing the electronics marvels of the time. So it was almost inconceivable that Japan would not just keep going up and up in stock price. But in fact, at that point of greatest apparent confidence, it began what has now been termed by many started as the lost decade. Now it's essentially the lost 2 decades. And yet intermittently, as we've gone along, there have been it doesn't look like there have been tremendous rallies in here, but just let me read off a few of the percentage rallies that occurred in that 20-year decline. 35%, just under 50%, 40%, 60%, 60%, 20%, 150%, and then almost 100% in this rally over here. That's almost 100%. And yet today, the Japanese stock market is 75% below where it was at this peak back at the end of 1989. And the only people who have profited in the Japanese stock market are people who were trading on a timely basis. They timed well getting in, they timed well getting out. Buy and hold strategy obviously did not work in that stock market over that period of time. Now we have to hope that that's not a template for what will happen in our US market for another decade or so. Although we are attacking the problems, our financial problems, in much the same way as Japan did. We're bringing interest rates down essentially to zero. We are bailing out banks that, had they been left to their own devices, may well have failed. And we're not forcing our banks to recognize bad loans. So far we're not deviating much from what the Japanese monetary authorities did. And the next page shows a very scary, similar trading pattern. On the top, we see the Nikkei from 1988, which is the lead up to the peak, through 2001. So this is really only roughly the first decade plus of its decline. And this down here is the NASDAQ, our NASDAQ, and you can just see, it's not perfect, but no analogy is perfect. And every analogy ultimately breaks down. You can't say, wow, look how close they're running, and then with any degree of confidence say it's going to play out the same way. You can't know that. But when you have an analogy that's following a similar pattern, follow it until it breaks. Take a look. All analogies, as I say, ultimately break down, but this does look remarkably similar so far. And I mentioned that at the March 2000 bottom, stocks were not cheap. Now, a year and a half later, corporate earnings have grown strongly. We've had a lot of corporate earnings growth over the last year and a half after the greatest stimulus effort in world history. And how do the valuations look today? If you look over, starting on page 29, I've got 6 pages of valuations which I will run through pretty quickly, just identifying the patterns for those who haven't seen them before. But if you read the press and you watch financial TV, you regularly hear that stocks are cheap. We hear a lot of people saying stocks are cheap. But if you look at these graphs, and most of them go back into the 1920s, some only go back into the 1950s, but an honest observer would have to confess that they can only be considered cheap relative to the extreme valuations of the past decade and a half. Look at the most traditional measures of value which we have here. The first one is price to book value. And I will look, the top half is always going to be the same. It's just a logarithmic movement of the stock market. So my concentration is going to be down on the bottom half of each of these graphs. And this red line, which goes up and down, is the price to book value ratio over time. Another way of looking at the price to book value ratio would be how much are investors willing to pay for $1 of book value? So in other words, if you look, the 83-year average here of price to book value is 1.84. That means that on average, over that long period of time from the 1920s, investors have been willing to pay $1.84 to buy $1 of book value. That's the average. Obviously, it's gone above and below. But, and I would get you to look at this on each of the graphs. In the period at about the mid-1990s through very recently, we have been in ahistoric territory. We have been at valuation levels that are absolutely unprecedented in U.S. history. And to call this cheap here, where the red line ends, it's true only relative to where we've been in here. If you go all the way across, this is as high as it's ever been, but for the last decade and a half. And we know that the returns on stocks in that decade and a half have been non-existent. So rationally, why would you say something is cheap and compare it to something which has been non-productive? I suggest that to really get an idea of valuations, essentially rule out the last decade and a half and look at the whole rest of our experience. And this is right about at the highest levels of valuation. Turn over to the next page. It's price to dividends. Same format. Again, the ratio is how much would I be willing to pay on average, or how much would I be willing to pay to buy $1 of dividends. You can see that the long-term mean is just over 26 over here, which means I'd be willing to pay about $26 to buy $1 of dividends. That's just under a 4% return on average. So that's the average over 85 years or so. And obviously it's been higher and lower. We have again our extreme decade and a half. But if you look at where we are now and go all the way across the graph, this is higher than it's ever been, except for that decade and a half of craziness which produced nothing for us. Today we are under 2% dividend, by the way, compared to 4% on the average over the long pole. The next graph is price to earnings, and this is the one valuation graph that most people pay attention to. It's the one you hear about the most. And this is the most reasonable of all of the valuation graphs. As I said a few minutes ago, we've had a tremendous surge in earnings, in corporate earnings, from the first quarter of 2009 on. But again, and of course, you see the most recent, the average number got skewed badly because of the extreme run up here in where earnings essentially disappeared, so the ratio went sky high. But if you look here over the long pull, but for that extreme where earnings almost disappeared, the average PE ratio on an as-reported basis has typically been between 14 and 15. It's gotten skewed higher because of the extremes of the last few years. When at today's close, we closed at 17.6 times trailing earnings on the S&P 500. So that is up in the area where it's not at the highs, but it's darn close to the highs, and it's way above where it has normally traveled over most of the last 80 plus years. Price to sales is the next graph. This one doesn't go back into the 20s. This one only goes back into the mid-1950s. But again, the picture is the same. Where we are here is cheap only relative to that recent decade and a half. This is right about at the highs of the whole history of that study. And then price to cash flow on the next page. Again, same picture. Chop out this and you've got your clipping off tops right near the highest valuations.